right, ladies and gentlemen, welcome to another episode of our Property and Finance podcast. Today we've got a repeat visitor. I think this might have been the third.
I think it's
third time you've been on our podcast. We've got Rich Harvey from the Propertybuyer. Rich and I have done some seminars and webinars together, multiple podcasts, and I really love Rich's content because it's very investor focused, and there's plenty of investor buyers agents out there, but Rich actually supports his clients with data to support the transaction and educate them on the decision making. Today I'm going to go a bit of a different agenda. Rich actually was the one that wanted to share some insights on how to build a property portfolio and retire with $250,000. So Rich, I'm going to hand over to you on kickstarting this podcast.
Thank you so much for having me. It's been a great pleasure to be with you, and it's going to be a great discussion today. Today, we're going to be talking about how to retire on $250,000. It's a noble goal. Everybody would love to retire on $250,000. A lot of people think it's unachievable, but today, let's unpack it and make it achievable. What do you say?
Yeah, I love it, Rich, and always love our sessions together. And this topic is of great interest to ourselves. We love sort of mapping out these strategies for our clients.
Perfect. Well, before we talk about the actual end goal, let's talk about setting goals. I think a lot of people don't know how to actually get started with goals. You know, January comes around, 1st of January, you set your intentions, but really they go nowhere. There was a Harvard study done once and it said that only 3% of the population actually set goals. So if you're listening to this podcast, you're watching this podcast, I certainly encourage you, get a piece of paper, write out your financial, your social, all your other types of goals for the year, but particularly get specific about things. And that's why I've made the topic of this podcast, how to retire on not just a nice income, but retire on $250,000 per annum. So today we're going to talk about how to reverse engineer that, how you can build true financial wealth, true financial independence, and really get going with it. So yeah, there's a lot to unpack there. What do you say?
Yeah, there's definitely a lot to unpack. So let's just jump into it. I think that's a great target. Also, $250,000 a year. It's a lot more than the average salary, which is good. But yeah, if you reverse engineer that target would be to try and get what depends on the yield and how you've spread it in terms of asset classes for investment. But if it's property earning 5%, it basically needs to be there about a $5 million target, right?
Correct. Yeah. So look, I mean, at a 5% net yield, you're going to need $5 million of unencumbered property to generate $250,000. So the way to calculate that figure, if you're writing it down, it's just 5 million divided by 0.05, and that'll give you 250. So but that doesn't mean you're going to earn 250 from the first day one, right? Yeah,
no, exactly right. I was also going to say, as you approach retirement, you might adjust your portfolio into different types of asset classes paying a much higher yield than 5%. For example, right now you can look at private credit investments, just investing in debt funds that pay you 10% thereabouts. So you'd need half as much if you were looking at those type of investments.
That's right. I mean, there's a lot of ways to skin the cat, and we're primarily talking about property, but we'll talk about some other types of assets that contribute to your overall retirement goal. But you don't want to put all your eggs in one basket and be relying on one singular income stream. I think that's the other thing. We're not financial planners here, but it's really important you've got the right set of advisors around you, and we'll talk about that a bit later. But I think just in terms of crunching numbers, you've got to start somewhere, Theo, haven't you? So if someone's got, a couple of $100,000, are they better off just putting that in a term deposit? Are they better off just putting that in the bank? Or what's the best way to actually achieve that goal?
Yeah, so this is a topic that we love sort of sharing with our clients. We hold sort of investor seminars and webinars on this exact point. The problem about comparing, let's say, what the figure you picked, 150, was it?
Yeah.
The problem about $150,000 in a term deposit or in shares or in a super fund, for example, is that you're just getting growth on that amount. And we've got, historical averages I've got here. I'm showing what a lot of those asset classes have done for the last 10 years. And if you look at the ASX 200, for example, total for the last 10 years, total return, which is inclusive of also dividends, distributions, is 7.9%. And so if you've got $150,000, you're getting 7.9%. $150,000 invested, you're getting 7.9% on that total figure. Now, the other thing is if it's a super fund, you're probably getting less than that figure because historically, 80% of super funds haven't actually even met the ASX index as a benchmark. And once they take their fees out of the portfolio, it's less than that. With $150,000 in property, you could, what we've modeled out here is you could buy a $700,000 property, which is at a nice healthy gearing level of 80%. So not aggressively geared, no LMI, and you could potentially achieve positive gearing from day dot. So the rent should cover the interest. At that level, let's say $150,000 invested at $700,000 property. Once again, if you look at historical averages, Sydney, for example, which you might struggle now with a $700,000 property, but Sydney and Brisbane and other marketplaces have sort of returned 6 to 7% for the last 10 years as historical growth. So you're getting that same basically growth as the ASX index, but you're getting the 6-7% on that property price of $700,000 as opposed to the $150,000 of cash you have, and that is the compounding effect of the power of leverage. Basically.
Exactly. I was going to say the power of leverage is something I learned very early on in my career. Not just being an economist in my past life, but when I learned the power of leverage, I bought 3 properties my first year. My broker went, "You're going crazy, Rich." I said, "I want to get to my retirement goal faster, right? I want to run hard." So every dollar that you borrow from the bank, you can leverage it 5 times. And that's fantastic. You know, I'm really into using OTP, other people's money, because that's going to get me to my goal safely and faster. So as you say, the power of leverage, but done safely. We're not talking about borrowing more than you can afford to repay. It's about borrowing as and when your capacity allows. And if you do that judiciously, if you do that carefully, and you do that with the right kind of assets, it's really going to compound your wealth. So I think it's really important, Theo, in the first instance, to understand that debt is a good thing and debt has power. I mean, debt can also amplify your losses, but amplify your gains the right way. And property is very stable. That's the safety factor I want to talk about today in this podcast, because as you've said, over the last 10 years, even the last 20, 30 years, I've done some numbers. And the main capital cities, Sydney, Melbourne, Brisbane, have all done between 7 and 8% per annum for the last 25 years. So I have no reason to believe that's not going to continue, simply because we have a shortage of properties in Australia again.
Well, the fundamental drivers of price growth is still there, right? Which is population growth is one of the biggest factors. And you look at markets like Brisbane, and I think it's close to 2% per annum in population growth. So like if at that growth rate, I think Domain released some data last year that shows every 1% growth in population equates to an 8% growth in prices in that marketplace. I just want to wind it back to something you said, which is so crucial because it's a core part of this strategy and consideration: safe debt. Because I do see a lot of some of your friendly competitors will say, really pushing
the envelope a bit far.
Pushing people to buy investment properties at really high leverage, and that is where things get risky. So I don't think you should be using a 30 grand deposit, let's say, to go buy a 300-400 grand investment property in some of these marketplaces. Or
well, how hard should you gear? I mean, this is the thing. You've got an accelerator with leverage. Like, how fast do you put your foot on the accelerator with gearing?
I think 80% LVR is the comfortable level because also it's the most cost-effective level. Once you go above 80%, you're paying mortgage insurance, you're paying a higher interest rate typically as well. So there's also just a much bigger impact on your net position of cash flow. So I think 80% is safe, it's comfortable. Anything above that, it's, in my opinion, you're getting a little bit uncomfortable. And you need to be able to sometimes ride a storm, right? Like weather a storm, I should say, where, there could be periods where there's a bit of a, global financial crisis that we've seen in the past. It could be periods like we've just been through recently of interest rates going up and down and confidence going up and down. And you need to be able to get through those periods and not be so leveraged and concerned that, a couple months of lost rent because a tenant had to vacate or whatnot is going to impact you. Although most of these marketplaces, you won't have a couple months of vacancies.
It's pretty unusual. But your point there, I think, is purely, Theo, around buffers. And I've got to say, my wife and I, we always have buffers in our accounts. So we get our broker to set up a buffer account or an offset account, and that's just going to guide us. So as you say, you might have a period where a property's vacant for a month just while you're renovating it or fixing it or whatever. You might suddenly get an interest rate rise out of the blue. Your bank could actually raise rates unbeknown to you, not because of the RBA, but because of whatever factor that's in their contract, right? They can do that. So probably unlikely, but you just got to have those buffers in place.
Well, it could be external factors. And if we just, case study what happened recently as an example, like you could have bought property back in 2020 and 2021 at record low interest rates, and the federal government is telling you that rates aren't going to go up for 4 years. And then, 12 to 18 months later, all of a sudden we're seeing the biggest increases in interest rates on record. And if you were at 95% LVR and extremely leveraged, your property then becomes extremely negatively geared, right? So then your personal cash flow, maybe on your primary residence, if you have a mortgage on your home, is impacted. And, we've seen people in recent years have to sort of part ways with investments they made in those years because they were too aggressively leveraged. So I think that to conclude the safe point, 80% is a comfortable point and a comfortable position. And I think also if you're looking at the right marketplaces that you look into, the yield is the second crucial element of staying stable and staying at a healthy level to cover that at 80%.
Perfect. I think a lot of people want to jump to the retirement question fairly quick, but let's sort of just actually jump there. What's the optimal level of debt you should have as you approach retirement? Like if you're in the late 50s, early 60s, should you be running everything at 80% or are you too highly geared at that point?
Well, it's funny, actually. I did an article with The Guardian on exactly this topic last year, and we're seeing more and more Australians actually go into retirement with debt. Now, I'm not saying go into retirement with 80% LVR, that's for sure. Definitely go in, the goal would be something below 50% of your asset portfolio, which would give you a healthy income on your investments if it is an investment portfolio. But if a lot of people were also, in the data that we share with The Guardian, is that a lot of people are going into retirement still somewhat working part-time. People are working for longer, but just working less, right? So working maybe 2-3 days a week, staying mentally active. So if you do still have income, to go back to your question, it's kind of case by case, because if you still do have some form of income, then maintaining some form of minimal debt is
tax effective.
Tax effective and also comfortable and not risky.
Yeah, perfect. No, that's a good point there. Is there any way, sort of optimal way to structure your loan arrangements for maximum flexibility? Like if you're buying multiple properties and multiple loans, what's sort of the best way to structure that for your lifestyle as well?
Well, there's several ways to skin the cat in this topic, but I've at the moment, variable rates and variable loans are probably most suitable just because of the changing landscape of interest rates. So you want the flexibility of refinancing to a different bank who might have a more accommodating lending policy. So what I mean by that is that serviceability and lending policies amongst banks really vary, up to 30-40%, you could say. So one bank could say they'll lend you $1 million, the other one could say 1.3, 1.4. And you want the flexibility of switching banks and taking your facilities from one to another to do so. That's just been in recent times. When rates were rock bottom back in 2020, I would have said fixed, that's for sure. But the reason why you want that flexibility as well is, when you're purchasing, let's say, your second or third investment, sometimes you might want to restructure your existing facilities and put them back on 30-year loan terms to reduce the repayments and improve your serviceability. So keeping your loans variable will give you the flexibility of refinancing those facilities and sort of stretching out those payments, because especially with an investment portfolio, if you still have an owner-occupied debt, you want to focus on paying off your owner-occupied debt first and paying off your investment debt last. So stretching out the repayments and refinancing every 2-3 years on the investment side is quite a crucial part of that strategy.
No, fantastic. Great advice. Let's talk about the building blocks. How do we get to that 250K passive retirement? Let's talk about the first property, second, third, fourth, and multiple properties. So I think one of the first things is you've got to focus on a combination of growth and cash flow. My advice to clients is very much tailor-made. There's no one size fits all with our clients, because I might have a client that's on 80 grand a year and I've got another client on 300 grand a year. Right? They're going to have different strategies around their tax as well. So I think it's really important that you should be focusing particularly on the growth as you're in the early accumulation phase, but also make sure you've got enough rent coming in so that you don't run out of serviceability. This is, as you would see there, continually you'll find clients that just run out of serviceability way too quick. So if you go down the negative gearing route, I'm not saying that's the wrong way to go. I actually think it's a fantastic thing to take advantage of.
If you're earning a high income.
If you're earning high income, it's a great way to go, but it's a good balance between growth and cash flow. So let's unpack that a bit. What are your thoughts on that?
Yeah, so there's lots to consider there. And once again, it's case by case on your situation. If you are in the top income tax bracket and almost giving away half your income in tax, negative gearing is an objective of yours, that's for sure. If you're not in that sort of bracket and you're actually looking for some income to start sort of building a passive income on the side outside of your sort of profession or career, then you probably do want to somewhat maintain your serviceability, to your point, Rich. And I think there's different ways to do that. So one thing that's quite common is purchasing investments in a trust. You can actually, certain banks exclude that debt from your personal servicing position, which will then maintain your borrowing ability to, let's say, upsize your home in the future. Because something we see often is that people like the idea of buying an investment property, and they might go buy one or two, but then 4 or 5 years down the track, they've got married and grown a family, you could say, and had children, and all of a sudden they need to upsize their home. But the investment properties, while still positively geared, might have an adverse effect on their serviceability and borrowing capacity, just because of the assessment sort of buffers that banks put on debt. If those investments were in a trust, that would hive off that serviceability buffer, or that, so say, that hindrance on your borrowing capacity with some banks. But if they're in your personal name, we've seen some people being forced to sell those, or sell a investment, let's just say, in a period of time, let's say after 3-4 years, where you haven't quite got the gain that you should, because especially when you factor in stamp duty and selling costs, if you average it over that 3, 4, 5 year period, taking a significant chunk of that gain away. So various things like trust is one. Another good one is your self-managed super fund. So you could set up a self-managed super fund quite easily these days. If you've got $150,000, $200,000, either on your own superannuation balance or combined with a partner, family member, or friend, you could set up a SMSF and buy a property where the debt in that SMSF is excluded once again from your personal serviceability. So there are ways to sort of maintain your borrowing capacity and keep buying additional properties without limiting yourself.
Good, some really good points there. I'll just pick up a couple of points, if I may. One is that patience is required. Right? I see a lot of impatient investors out there. They buy their first one and go, Rich, I want my next one tomorrow, and they can't quite afford it, but they really want it. They want to buy two. My friend bought two, why can't I? But it's all dependent on your own financial circumstances. Or they might run into a bit of trouble and go, oh, the tenants are paying, I just can't handle property investment. I get out, they sell after 3 years, and they kind of just break even. So I think it's really important, anyone listening to this, that you be a patient investor. Capital growth does the heavy lifting, particularly over time. If you look at the compounding effect of capital growth at 7% per annum, it's phenomenal in the second 10-year period, between 10 and 20 years, and then between 20 and 30 years, it just takes off. So the longer you hold your portfolio, the better. Is one point I'd like to make.
And just on that point, that's why making sure you get the right advice at the point of transacting and setting up these structures is crucial, right? So that, to my point about hindering your future serviceability, you have to consider those things when making the investment, and speak to your accountant, get the right advice, and look at these structures like a trust or self-managed super fund, because you can't reverse these decisions once they're already in place.
Yeah. So I was talking to my son about buying property. So, Dad, how do you own so many properties? How does the bank give you all the money? And how did you do it? He's at the age where he's just staying at the bank buying his property. So I said, well, it's actually pretty simple, but let's sit down and I'll explain it. And I talked about harvesting equity, right? So once you buy your first property, you build up some equity, and you go back to the bank. You say, look, I've still got a good income, and look at this equity I've got. I've got 300 grand equity in my property. And you harvest that. That's probably the best word to use. I like that. It's like growing a tree. You can take a bit of timber off. You don't kill the tree. You take a bit of timber and harvest it. But if you do that strategy and recycle your equity, it's a fantastic way to go. Like, not many people can save 100, 200, 300 grand a year, can they? I don't see people saving that kind of money. But your property portfolio, as you build it, it's spitting off that kind of level of equity every year. And if you can then tap into that and use that as your deposit for your next property, and then rinse and repeat, that's the simple strategy to retire.
Well, I've actually got some calculations and data on that, using some historical assumptions, because this is the topic I said that got a lot of interest recently in a blog post of ours. We've actually, like I said, used a case study of $150,000 deposit in total to buy a $700,000 investment property.
That's reasonable.
Right?
Great.
And if we assume 7% as the annual growth rate, which is also the historical average for the last 10 years or so in most of these marketplaces that we're referring to. So historical averages, apply them for the next 10 years, and using that $700,000 property as a case study. After 4 years, the equity in that property at that 7% growth rate compounding should give you the ability to buy another $700,000 property with $150,000 worth of equity accrued. Then every 2 years after that, you should be able to buy another $700,000 property. So then in 10 years, you should have a portfolio of $5.1 million, all from $150,000, which would be 5 properties.
Now, a couple of points I'll make. If you use Propertybuyer to help you buy your first property, we'll try to get you a property at 10% growth rate in the first couple of years, which will accelerate your plan by 2 years, right?
Yeah, so these are conservative assumptions.
But these are average. I hear what you're saying.
Yeah.
But that's beautiful. I mean, that's a really great scenario that you outlined there. Just having 150 grand to start with, the power of leverage, getting the rental income from the property helps you to support the loan, but then recycling that equity into the next one will get you well on your way.
And look, just to circle back to the objective here of the $250,000 in passive income, whilst in 10 years that won't achieve that, because if you've got 5 properties at an 80% debt level, you're still using the income to service the debt. However, it's then your ability to, like your options at that point are, you've got a $5.1 million portfolio that if it's appreciating at 7 to 10% per annum, you're getting $500,000 in growth per year. If you're comfortable to maintain that and don't need income, so be it. If you want to start looking at paying down the debt and accruing a passive income, you can just restructure and sell a property or two and pay down some debt.
And there's nothing wrong with that. I think a lot of people think you have to hold forever. But, I'm at a point in my own portfolio now, we were just talking before off air about rebalancing portfolios. Once you get, maybe your late 40s, 50s or early 60s, you're at a point where you go, actually, I don't need to accumulate anymore. I've got enough. I've actually got enough to do it now. And you can actually start to slow down. You could rebalance your portfolio. Yes, you've got to pay a bit of capital gains tax, get the right advice from an accountant, but that's how you do it. So if Theo, you're saying that gives you let's say that's 5 properties, you're going to end up with 5 million. Over the next, 10 years, your portfolio will be worth more than 10, right? With the effect of compounding to that number, it's probably going to be 13, 14, even maybe $15 million. At that point, absolutely, you've nailed your goal of 250.
Yeah, you could. If you're making these decisions in your 30s and 40s, then you can just leave it, and then by the time you approach retirement in your 60s, you would have that comfortable debt level giving you that $250,000 of income plus up.
So for me, it's a highly achievable strategy. It's not a risky strategy. And this is also independent of shares and other types of investments. We're purely, guys, just talking here about property. So, if you get a good financial planner on your case and helping you with the other parts to give you some more liquidity in your portfolio, it's a great strategy to go for.
I want to touch on something you just said, which is also another important consideration, and that's rebalancing your portfolio. I feel like a lot of people don't actually do that. A lot of people that we see in our sort of day-to-day conversations, they sort of set and forget. And yeah, sure, that there's an argument that works, but sometimes if you're hanging on to your first investment property, which is something I did recently as well, I hung on to my.
You're emotionally connected.
Yeah, I'm emotionally connected. It was my first home.
Yeah.
It was a terrace in Paddington, and I had nostalgic memories of being in my 20s and living in a terrace in Paddington, and I didn't want to let go of it. But now, after 15, 20 years looking back at it, maybe not 20, about 15 years later, I looked at it and I was like on its current value, not on what you paid. Obviously, you've got to look at its current value because that's your opportunity cost. On its current value, it's yielding maybe 2.5% gross, and you've got to work that backwards to net. And the net was about 1.5%. So you've got to start thinking, well, where can I redeploy that and also be in a better debt position because it was much.
So just on that, my economics head comes in. That's an inefficient use of capital, right? That's
exactly.
A very inefficient use of capital.
Exactly.
So pay your taxes, get out of it, recycle it, and then what are you going to do with it?
Well, I re-gear it again. That's the crucial thing. So whilst I've had decent growth, attractive growth, I'm still at the early stages of my career, in my opinion, and I'm comfortable with debt, and I want to be at a higher.
So you say you sell it?
I'm selling it,
Yep.
yeah. And I'm actually just waiting for interest rates to come back down to sell it to hopefully get the optimal price.
Yes.
And then I'm going to sort of reposition that capital. I might actually look at putting some back in residential at a higher LVR because my current LVR on that is maybe about 30%. So I'll reinvest a chunk of that at 80%. And then also diversify and access some commercial property, which I love, just for a high yield that still has obviously leverage, but at a lower level. Well, higher than its current capital use.
So do you have it's another side topic, but do you have a benchmark to review properties? So obviously the performance of that property is suboptimal. So do you have like a particular criteria to say, look, I'm going to rebalance my portfolio and sell that one if it doesn't get a yield above X? Do you have that sort of mindset?
Yeah, I look at a range of things. So this one in particular, it also is now needing some serious maintenance. It's deteriorating somewhat, and someone needs to come along and do a significant renovation, and that's not going to be me because I've already spent a bit of money over the years, and that's just eating once again at my yield, right? Whilst you might get some tax incentives for it, it's costing a fair bit. So that's one thing, just looking at the actual property itself and what work might need to be done on that asset. The other thing is just what I was sort of alluding to earlier, just the yield. I look at other marketplaces, I look at other asset classes, and I think, well, to your point of a poor use of capital, where can I deploy that capital at a much better return or a much more efficient debt structure? And I'm just constantly sort of analysing alternatives. And once again, I guess the key words there is the opportunity cost of leaving that money in that asset, which is giving me an inferior yield.
No, really good points. I just think there's a whole lot in that that's gold for people listening to this today. Let's talk about, I guess, the accumulation phase. So let's say we've assumed we've got our first 1 or 2 properties. A lot of people, I find, stop at that point. Either they're, for whatever reason, life gets in the way, they're having kids, they're changing jobs, they've got family issues, and they just stop after 2 properties, right? But the smart investor knows how to get through. They know how to go, you know what, I'm going to get my 3rd, my 4th, my 5th. I want to get to that 10 or whatever number. It's not so much the number, it's the value of property. I really sort of emphasise. But let's unpack the roadblocks, if you like, there, because I think a lot of people, either they're scared of debt, or they just don't have the time, or I don't know, what are some of the other reasons that people slow down on this accumulation phase?
Well, the biggest roadblock would be serviceability, which we touched on earlier. And that is, what I mean by serviceability, I don't mean on your actual ability to buy a property and service the loan. It's the bank's assessment of your serviceability. And that has really hindered investors in recent years. And if you've set up structures incorrectly and you don't have things in trust or an SMSF or, and you purchase assets in your personal name and you've got maybe an investment property or 2 also with a very low yield that's then affecting your serviceability, that becomes the roadblock. And that also becomes a reason, to our point earlier, of maybe repurposing capital, because if you sold an asset and got into something that, let's use my example as a case study. If I'm getting 1.5%, 2% yield and I go buy something for 6% yield, it's going to improve my serviceability drastically, right? But yeah, the thing on the trust structures and getting the right advice, I'm not saying you necessarily need to buy all your investments in a trust, because there are some reasons to potentially buy a property in your personal name as well. So a big one is if you're a high income earner and wanting some negative gearing benefits, because if you buy in a trust, those negative gearing benefits are hived off in that trust. So it's a little bit limited, where if you purchase in your personal name, any losses can then go against your personal income. So it's about, I guess, talking about roadblocks, you really do have to get the right advice to map out that strategy so you don't hit those roadblocks. And if you do hit those roadblocks, then make the appropriate decisions and adjustments to then maintain building that portfolio.
Yeah, I can tell a personal story about that too. I mean, I've bought a number of properties in my own name and in trust, and I'm pleased I've done it that way. It's not always like the disadvantage of buying in a trust, particularly in New South Wales, is you don't get the land tax threshold, right? So it's a killer. I just got a $24,000 land tax bill the other day, so ouch. But the rental on the property is over $80,000 a year, so it's okay. So it's still positive cash flow. It's not going to kill me, but at the same time, it gives you that flexibility. So it's important, sometimes you get the right advice. I've had some wrong advice along the way and had to spend $30,000 getting out of a particular structure to get into a new one.
That's a good point.
But I'm pleased I did it, because now I took the pain, I ripped the Band-Aid off of that structure and got into a much better structure. So what I'm saying is that make sure you choose the right advisors up front, so you don't get referrals, get references. And make sure you've got the right structures to do that, because I think it's really important you get the right structure.
Can we just maybe give an example of some bad advice or an incorrect structure? So something that we sometimes see here and there is people buying assets in a company
With no trust.
With no trust. And they might have done it as a set up the company because they got advice, and they maybe misheard the advice about using that company as a bucket company to transfer profits from their main business. So if they're self-employed and they just want to pay company tax only and then use that those profits to buy an investment, they go set up a company and buy in the company. Biggest issue with that, to your point, is it's not land tax, but versus a trust, is you don't get the capital gains tax discount. So what I mean by that, you have to pay income tax on your gain. Well, if you keep the gain in the company, it might just be company tax, but then when you pay it out, it's full freight income tax. So that could be, 47 cents a dollar, or 48. So I think decisions like that are hard to come to terms with after the fact.
Yeah, especially 15 years down the track when you didn't realise or didn't listen to the advice carefully. So make sure you know what you're doing. So let's just talk a bit more about the accumulation phase, Theo, in terms of, I guess, property strategies. And one of the things that I advise our clients is you can do a number of different strategies. You can buy a set and forget property, you can buy a value-adding property, you can even buy developments. But I think there's a way, depending on how hard people want to run, they can actually accumulate properties faster using a range of strategies. My advice here is just go in with your eyes wide open. Realise that if you're going to be going down like a development route, you've got to be very prepared to have the right resources around you to get through that. Like people think, oh, wow, development, I'm going to make a mozza. But I can tell you from personal experience, a lot of developments do not work out as you've planned. Things can hit you from left field. So the simplest and safest way is buying a great quality property and doing pretty much not much except for maintaining it, right? Just enjoying the capital growth. But there's little things you can do. I've added granny flats, I've done renovations, I've added stories, I've done a knockdown rebuild, right? And all of those do accelerate your wealth a bit quicker. Like adding a granny flat, for example, is going to boost your yield. That's going to help your serviceability. It's going to help pay down the debt a lot faster, right? Adding a bedroom, adding benefits or air conditioners, I think that improves the rental return you get on the property, right? So those kind of things can really also. What are your thoughts around accumulation at a faster rate?
Yeah, well, let's go back to also maybe not falling for the thing that looks all shiny and pretty. I have fallen for that. Once again, we'll talk about my personal experiences. I bought a brand new property off the plan in 2014, was the exchange of contracts, and I settled on it in 2016. And in that period, it still hasn't even doubled in value. It's probably increased by about 50% since 2014.
Oversupplied area?
Well, it's not really an oversupplied area. It was just that I paid, I think, top dollar for it because it was a brand new.
You paid a retail price, not a wholesale price.
Exactly, and also it was the cool development. It was a development in Surrey Hills. It was a warehouse conversion. So I thought it was unique. I thought it was going to be rare because there wasn't going to be many alternatives. But it just hasn't been the best investment. Top of that, talking about some of these brand new developments in certain areas with questionable developers.
Yes.
I'm now going through a special levy because the builder didn't do the best job of waterproofing the rooftop garden for the penthouse, and now we've got water leaks going down the building, and it's going to be a huge special
water
levy.
Penetration's the worst.
Yeah, they've got to redo the whole membrane on the rooftop, and that there's been a bit of that with questionable developers in certain marketplaces. So, yeah, unfortunately, I haven't had the best experience. And I'm with you by, especially with my Greek heritage, where I was always brought up to believe in bricks and mortar. Buy land, buy an established home, especially something to your point with some spare land at the back where you could put a granny flat. I know your granny flat providers actually reached out to us recently saying how many they're doing for some of your clients. Absolutely. And how great case studies it produces such passive income from little investment. That's right? Yeah. Speaking of which, so that figure's changed over the years, right, in terms of the investment needed. What do you think that figure is needed to put let's say a 1 or 2 bedroom granny flat in the back of your property?
Oh, I'll give you a personal example. The range used to be, going back 10 years, like 15 years, we used to do heaps of granny flats. We did probably 400 granny flats out in Western Sydney. And back in the day, you could do it for 90 or 100 grand, right? Now with building costs, your minimum really for like a 1-bed is about 150. I spent 240 doing a 3-bedroom granny flat. You're going to say, how the hell do you do a 3-bedroom? Well, that's a secret, right? But we managed to get a 3-bedroom granny flat, and I'm getting $650 a week rent for it. Wow. So it's yielding about 15%. Just off the granny flat. Yeah. It's about 6.5% off the whole property. I think around 150 to 250 will get you a good quality granny flat. But you've got to get the right, 60 square metres is the size. But in addition to that, you can have a garage, you can have outdoor areas. So it can be bigger than 60 with the outdoor areas as well.
How do you feel about, and this might be not the best thing to talk about compared to those people that just reached out to me that you work with, but I've seen a lot of people do these modular builds now. It's becoming more common, especially in regional areas where it might be hard to find typical builders. And some of these modular builders are now doing the granny flats too.
You get what you pay for at the end of the day. Look, I've looked at a lot of those modular ones, but I haven't been as happy with the quality, so I haven't been able to recommend them. Like I wouldn't. A friend of mine did a shipping container one, right?
It's a flat stack, right?
It's a shipping. No, it's literally a shipping container. Turned into a granite. Cost him $50,000, but he had a nightmare with the company. The company actually went into insolvency. But they obviously weren't making enough margin. So that's the thing. Like if it's really cheap, just make sure the company's going to be around for the long term, because getting it installed and getting it finalised was a nightmare for my mate.
Yeah, you get what you pay for.
Exactly. So that's on my point. So look, yes, you can do. Look, some modular building can work.
Yeah, there's some good ones.
Yeah, but I guess you've just got to look at longevity. For what I want is, for me, it's like I don't want a problem with my portfolio in 10 years' time. I want to know it's going to be looked after and it's going to be stable and it's not going to have any big issues.
Yeah, I have seen some of my clients raise ones they saw on Alibaba, and they come as a flat pack, and then you just pay a builder to put it together.
Yeah, right. So anyway, let's also just talk about buying strategies in different areas too, Theo. So I think one of the things in building a portfolio is you do need to diversify location to take advantage of different markets, not necessarily different property types. We've talked about buying off the plan versus buying an established property. In my view too, just on that, I definitely believe in buying established property is a much better way to go, because you're paying a wholesale price. You can see what you're getting, not having to wait 2 or 3 years for market fluctuations, then have issues with the developer that maybe hasn't considered water penetration issues, right? But you're paying the developer's margin. You're paying big commissions as well when you're buying brand new. So for me, off the plan is not generally. I have done it. Then you can still do it well if you know the developer you're buying from. So, for example, I'd be happy to buy a Mirvac development, not a Meriton, but a Mirvac. Mirvac have the highest standards. They're unbelievable. The amount of time and energy they put into their infrastructure, so they minimise their strata fees, is very good. So, really, really reputable developers are okay. But to the point about investing, I would typically advise to buy something on a block of land with a good quality house. Doesn't matter how old it is. I'm not chasing the depreciation so much. I'm chasing the future upside. So that's what I'm looking for. But let's talk about different markets. I think it's really important for people building a portfolio of $5, $10 or $15 million over time to make sure you've got exposure to different markets. So you don't buy all your properties in Victoria or all your properties in Brisbane, for example. It's good to have that different exposure. What's your thoughts on that?
Diversification is the key of that, really. I think the goal of diversification is that you might access different cycles at different periods, right? So you look at Brisbane and Perth have had a great cycle recently, a great growth cycle, where Melbourne hasn't, right? So if you had an investment property in Brisbane and an investment property in Melbourne, it's better than having 2 investment properties in Melbourne. So I think it's about sort of, and there's an argument to say maybe Perth and Brisbane could slow down, now Melbourne can play catch up. So I think just exposing yourself to different marketplaces will give you more stable growth.
Yeah, look, I think in terms of, everybody asks me, Rich, is now a good time to buy, and where should I buy, and what should I buy? But the timing and the where to buy is a very common question. And again, it's not a one size fits all. Like I had an investor the other day that's got 9 properties in Melbourne, right? And he needs to build a portfolio outside that area. He's obviously paying a crap load of land tax.
Yeah, now. Yeah.
So it's very important to diversify. But look, I think Melbourne definitely would be my top pick for being countercyclical investing. You won't get the yield in Melbourne in the next couple of years, but you'll definitely get the upside. So Melbourne's median house price is around $1 million. Sydney's 1.65. So buying something 60% cheaper than Sydney, it's never been that cheap. Never, ever. It's normally within 30 to 40% range.
Let's elaborate on that countercyclical investing. So basically, there's that common term in investing, which is an ugly one, but it makes sense. When there's blood on the streets, that's when you can clean up, is what they say, right? And that's sort of what's going on in Melbourne, right? Everyone's scared of investing right now. People are pulling out, and there's been some, property prices decline in some marketplaces, but that might be the time to jump in. You're getting things that are probably a devalued entry point.
Well, the early sign from my buyer's agent team in Melbourne is that there's going to be a lot of people looking, because the queues to get into certain properties at the moment are pretty strong beginning of the year. I think the message is getting out to the investor community that Melbourne is certainly a go-to area for capital growth. And you've also got a very large proportion of migrants that end up in Melbourne. Now, migrants typically rent for about 2 to 3 years before they buy. And we've had over 1 million migrants come into Australia in the last 3 years since COVID, right? So they're in the rental market now, but they're all going to enter into the buying market. So there's going to be more competition and more pressure on prices for all those people that want to buy homes.
And something on that note, I think it's really crucial that people stay up to date with accurate data, because some people might be hanging on to inaccurate data, or I should say outdated data from years ago. So, for example, if we're talking about Melbourne, the supply of units. The supply of units was quite high maybe, 4 or 5 years ago, but it's really dried up. Purchasing a unit historically hasn't been the best investment there because of that supply, but now it could be the opposite, because there's very little supply of new units coming to the marketplace now.
So really good point there. I'm pleased you raised it. We're actually being able to buy units in Melbourne at below replacement cost. So some of to build a 2-bedroom unit used to cost around 400K. These days it costs 800K just to build it. So we're buying some units we just have recently in those inner city suburbs for 800, 850 at or below replacement cost. There's not even accounting for the land value of those apartments, because there isn't good land value. So we've got Tass, who's one of our valuers in Melbourne particularly, and he's just having a field day, just analysing what the land value is on these apartments and saying it's such a good investment. So don't just think that houses are the only good investment. If you've got a smaller budget, then apartments can be absolutely a good investment in the right locations in areas that haven't traditionally done as well.
And on that point, it just shows that price growth really needs to be apparent before supply improves too, right? So if you're buying something at $400,000 or $500,000, but the replacement cost is $700,000, well, that property's got to get to that price before a developer can justify actually even making the numbers stack on development, right?
That's right. Yeah, perfect. All right, what else can we talk about? We've talked about the accumulation phase. Let's talk about this transitioning to a passive income. So let's assume you've got, maybe $9-10 million worth of property in your portfolio. You're sitting pretty. You didn't realise, but wow, you've got $9 million worth of assets. You maybe got $4 million worth of debt. So you're netting $5. You're netting $5 million. So you've achieved your goal. If you're at a 5% return, you've achieved your goal. What do you do at that point?
Sorry, can you just?
I'm just saying
the number was 10.
I'm saying we're at 10. Let's say we've got a $10 million portfolio,
and the debt's at 4.
And the debt's at 4. Let's say we've got net $6 million. Right?
Yeah, so you should have some significant. That should be positively geared quite significantly. But let's say you are looking to work less. Let's say that you are not wanting to take on a serious role where you're working long hours, 5 days a week, and you want to start building a income on the side that you can live off. Well, whilst that might be positively geared, you still do have $4 million of debt that's probably eating some of your overall income. So you can just repurpose that, readjust it. And this is when you can look at things outside of property at a higher yield. I mentioned the private credit funds before, but the only issue with private credit is that you're not getting the capital growth, that you're just getting that 10%, let's say, return. Not always 10, it might be less. As rates go down, that will decrease as well. But there's other structures you can invest in, even just maybe a high income ETF. So there are funds that you can buy, listed funds on the stock market. There can be a high income fund that's basically buying companies that are paying a good return. You can also look at these commercial syndicates where you can access both a healthy return on your capital. The one that we just did last year was 7% return on the capital invested, whilst then also getting the value of capital growth on your capital. So I guess it's not a one size fits all solution. It's case by case, but repurposing that portfolio and getting the yields that you want is basically the goal and the decision to make at that point in time. The other thing is, don't be scared of paying the tax to crystallize your gains. I feel like sometimes people, it's a hindrance and it's a roadblock once again for making the appropriate decisions. Paying tax means you made a gain, right? So it's okay to pay the tax, especially in certain structures like let's say your SMSF. If you did buy a property in your self-managed super fund and you did crystallize the gain before retirement, you're getting a discount on that gain. I think it's 10%.
It's 10%.
And if you do wait till retirement, it's actually tax-free, so that can be a roadblock. But then again, if you're 10, 15 years from retirement, repurposing that capital might be better suited than just paying the 10% tax. So yeah, there's many ways to sort of reposition your portfolio. But going back to that point that I mentioned about looking at the yield might have changed on your portfolio if you look at the current value of those properties. if some of these areas became really sought after for owner occupiers, you might find that the yield has decreased. So selling the assets to reposition that on its current value is crucial.
I think the thing is you can't take it with you. When you're dead, your net balance sheet's not going to matter, right? So the balance here is like looking at your age and you're almost trying to predict how long you're going to live. But, obviously you might want to leave a legacy to your kids and that sort of thing, which is a wonderful thing to do, and I encourage it. But, it's not about just, being the richest person in the room is the person that wins. It's about having cash flow to live on along the way and enjoying the journey. And I think a lot of people aren't even thinking about this rebalancing idea. And I think one of the things that I'm personally doing is transitioning some of my properties into high yield properties. So I did mention to you previously off air about buying more commercial properties and typically getting a net yield of 6% plus. That's a net yield, not a gross yield. Like a lot of resi is 5% gross, which is probably 4% net or under. But commercial typically give you 6% net. So that's something. But you do need generally a slightly higher entry fee. I typically think you need about $1.5 million plus to get a good quality commercial asset. Yeah, in my view.
Well, that's why I do like these syndicates, because if you combine your capital with other investors, you can get a better quality asset.
Sure.
And yes, some people say there's more risk in commercial. Yeah, sure. If you're buying, maybe a shop front on a
retail strip.
Yeah, on a retail strip in a main road, you might have a period where you might not have a tenant for 6 to 12 months, right? But if you're accessing, let's say a commercial syndicate with others, and you're buying a shopping centre like we did in the Gold Coast last year, which has 42 tenants, some like IGA and Guzman and Gomez and Oporto, you've got 10-year leases. It's minimal risk, right? What can go wrong? And that's the other thing I love about commercial is the fact that you have tenants for a longer period of time typically. So the annoying thing sometimes about residential in comparison is that you might have a tenant leave every 12 months. And whilst you're pretty much always going to get a tenant to go straight in after, there's still the 2-week letting fee. You might need to do some repairs and maintenance in that period. And it's just a bit more turnover.
So the other thing that I'm also recommending to clients is, particularly in Brisbane, you can do what's called a rooming house.
I love that.
It's like a co-living, but it's not a boarding house, it's a rooming house. So what it is, it's a 5-bedroom house, looks just like an ordinary house, but it's literally got 10 bedrooms. So every room has its own bedroom, plus a living area and a little kitchenette. Plus there's a common kitchen or common area as well.
As you said, sorry, it's not a boarding house.
Not a boarding house. So that's I'm just trying to make a point. It's not. So there's different rules apply for boarding houses, which have kind of got a bit of a prejudice against them. But rooming houses are a wonderful way to help the affordability crisis, provide affordable rental, and generate an amazing yield. So I'm looking at buying one myself. They cost about $1 million to 1.2 for a good quality one.
But you buy them and convert them?
No, you can buy them and build them. Or you can convert them, right? I'm typically going to buy them and build them from scratch, because it's all going to be, you're going to get a higher yield and you get a better rental and a better quality of tenant. But you can potentially get 9 to 10% gross yields, 8% net.
So you build them from scratch, and when you build them from scratch, is there ability to then, let's say, talking about repositioning a portfolio in 10 years, let's say in 10 years you want to let go of that asset because the debt's so low that the 10% yield has done a great job of paying down the principal. Is it easy then to reposition them back to a home if you'd sell them as a home?
Just sell it to another investor. Just sell it to another investor who wants the yield. But why would you sell it? It's just a cash cow. Just keep producing yield.
And these are typically really common in Brisbane once again, right?
Well, you can only do them in this area. There's only certain jurisdictions in council areas that allow these particular things.
It's interesting that there's still such a demand in those areas.
Well, affordable rental, you just think about it. Like if they rent them out per room, so the property manager manages it on a per room basis, which is great. And I believe that it's a bit like a little mini apartment block. So all the owners get to know each other, and it's like they've got each other's back, that sort of thing. So it's not like a lack of privacy. They've got their own courtyards, got their own locks on their doors. So I think it's a great idea.
Well, as a case study, there's someone in our team, a mortgage broker himself, actually bought one this week. And I believe, so some of these marketplaces you talk about, it's the northeast side of Brisbane.
Oh, there's different areas around in the Brisbane City Council area.
Yeah, and he bought something for, I think it was about $750,000, and it's 3 separate dwellings basically and it's a flat block of 3 separate dwellings. It's not like stacked. It's one big block with 3 separate dwellings, all side by side. Obviously, one house that's been split up, and he's getting 8% yield on it.
Yeah, fantastic, brilliant. We've got a short time to finish up with. I just want to move on to, I guess, mindset. I guess strategies for success. Like, What's your thoughts around how people should approach this whole idea of getting 250K as a retirement goal? What sort of mindset do you need to have, Theo, for this?
Well, you've got to make an effort is the step one, right? Like you've got to actually be willing to do what we said about the planning and pick up the phone and call your accountant and figure out these structures and spend some time with a buyer's agent, a mortgage broker, and understanding the things that we're sort of outlining around your servicing roadblocks in the future and structures to maintain that. And so that's step one, making an effort, because it's not going to happen without you picking up the phone. The other thing is, I guess, if we want to go back to the basics of day one and using, let's say, $150,000 and start building that portfolio, you should really make sure your finances are in the best position to do so. The one thing that is always a hindrance to your serviceability and just always a hindrance to just your overall financial position long term is unsecured debt. What I mean by unsecured, some people think a car loan is secured debt, which technically sometimes it can be, but we look at that as unsecured, unhealthy debt because it's a high rate on a deteriorating asset. I know there's been an anomaly recently in COVID where you might have preserved the value of your car because of supply issues, but car loans really affect your borrowing capacity is my point. Other things are things like credit card debt. Credit card limits is what gets factored in, but a lot of people still have debt that they are just paying at maybe anywhere between 12 to 20% interest, right? So you do need to make sometimes those sacrifices and dial it back on those fancy holidays or fancy restaurants. And these changes might put you in a better position as quick as 12 to 24 months to then start looking at purchasing investment property. Because if you've gone to your bank or a broker and they've said you don't qualify to buy an investment property and we can't get a loan approved, and you do have things like a credit card debt or significant credit card limit and car loans, these are the things that are affecting that decision or ability to do so. So, yeah, I think that's the starting point.
Yeah. Well, I think a couple of things I'll add to that is, my journey, I just got myself educated. I was working in the city at the time, and before I started my portfolio, I'd read one book a week. I set myself a goal. One book a week I'm going to read on property investment. And then I'd attend seminars. Webinars weren't a thing back in the day, right? So now these days, there's plenty of webinars. I run webinars myself, running one next week with Dr. Andrew Wilson, just talking about the whole Australian economy and where we're heading in the property market.
He's fantastic.
He's amazing. So doing one with him. So definitely watch that if you can. But yeah, just get educated. Talk to experienced people. Talk to other investors. Definitely get the right team. Get one of Theo's team members on your case to do your pre-approval. Get that assessment of your borrowing capacity. Talk to a buyer's agent like ourselves to work out your strategy and what your first, second, and third property is going to look like. Get your accountant to get your structures set up. And then there's a bunch of other people you need as well in your team to help you. So I think getting that mindset and realising it's a journey, and you're going to keep learning on that journey.
Just on that note, there's also the flip side of that is sometimes you can get too many opinions, right? So
that's it.
I think
analysis of paralysis, right?
Yeah, so to speak to experts that have done it themselves, I think is the key. So if you go speaking to all your friends and family and colleagues at work,
not the barbecue advice.
Yeah, don't get the barbecue advice where it's the person who's not doing anything themselves and they've got a lot to say about what you should and
the market's going to crash next week. You shouldn't buy until the market crashes.
Yeah, so speak to people that have built a portfolio and done some successful things. And the other thing is you might have 5 or 6 people in your network that have achieved a successful property portfolio, let's say, and those 5 or 6 people will have different advice too. So sometimes there's not the one size fits all solution once again, but taking bits and pieces from these various individuals and realizing what's applicable to your situation is the crucial part.
I think the other point to think about is just, we've touched on this a bit, is just active portfolio management. So it's a matter of you reviewing your rents, making sure you go back to your property manager every 12 months and say, hey, what's the market rent? Can I increase the rent? Because if you're not, then that's going to hurt your servicing ability. That's going to hurt your retirement goals. The more rental income you get, the faster you achieve your goal.
Once again, on that note, don't expect that the property manager is doing that on their own.
Correct.
It's amazing how you could be. Sometimes I've reached out to my property managers in the past, and I've gone past the expiry date of the lease, and I've said, "Hey, isn't our lease expired a couple of months ago?" They go, oh, yeah. And I was like, do you reach out to them and seeing if we can have a rent review? I was like, oh, yeah, we're about to do it this week.
Thanks for the reminder. It's their job.
Yeah,
Exactly.
so you do need to be on the front foot, and that goes the same with also, speaking to your accountant to make sure they're doing the right things with your portfolio.
Definitely. And definitely talk to your broker about refinancing and getting the cheapest rate on an annual basis as a minimum. We've talked about diversification. We've talked a bit about exit strategy. I guess just to wrap up, tell us about, I guess, what you think are the biggest mistakes that people might make when they're building a property portfolio.
So a real common one goes back to, I guess, that emotional thing of when you buy your first property and then you sit in that first property as your home, let's say, for 5 or 6 years, and then you maintain that property as an investment whilst you upsize into a family home with a partner. That is a cliche situation we see here in Sydney. Someone might have bought a 1 or 2 bedroom apartment for their first property, and they just kept that whilst buying then a 2-3 bedroom apartment or home, right? The problem with that structure typically is that you have a very low LVR, a low debt position on the investment, and a significant debt position on your home. Very unhealthy debt position to be in. It's meant to be the opposite. You want to have little debt on your home and more debt on your investment property. And if you've done that trajectory of maintaining your first property as the investment and buying the home, you're going to have the contrary typically. So I think, once again, going back to those hard decisions and going back to just sometimes maybe paying the tax and crystallizing the gain, selling that first property that was once your home, and then looking for a property that is actually you're buying it for investment purposes is the crucial realization, because typically the first property you bought wasn't for that consideration and might not be the best investment. Once again, in my case study, it's a low yield could be the issue there. And then when you speak to someone like Rich, you're looking in marketplaces purely as an investor. So it's a whole different purpose of that purchase. The other good thing about then purchasing the investment property after you've purchased your home is that you can once again have a better debt position by potentially using the equity in your home to fund that. So you can borrow 105% inclusive of cost.
No, really good point. Yeah, you're absolutely right. I do see a lot of people trying to hang on to that first place, and I'll just turn that into an investment property, but it's not leveraged correctly. It's not maximising the tax deduction. So, really good point. I think for me, the biggest mistake I see people make is two things. It's the procrastination, the opportunity cost, and secondly, it's the confusion in their head or the paralysis of analysis. And I was one of those people myself, right? Before I bought my first property, I would analyse things to the nth degree, and I just was afraid of debt. My hand was shaking when I was signing my first mortgage document, mate, back in the day. Right? But now I realise that you can do it safely, you can do it well. So, don't be afraid of taking that first step, but get the right advice and realise that the cost of doing nothing is absolutely massive. So many people won't retire well because they're not taking proactive action today, which they easily could and safely could, to build their wealth.
The cost of procrastinating is far worse. I have to say, back in my first days of engaging with homeowners and investors, which would have been Commonwealth Bank in 2007 when I started, and working in the branch network, I've been hearing the words bubble in the property market ever since then, pretty much every year or two. And if you look at the periods since then, almost 20 years now, if you look at the last 20 years when we have had corrections, those corrections have been pretty minute. So you look at the GFC in itself, it was 7% locally in Sydney, it came off. And we've had maybe a correction around the Royal Commission in 2018-19 and another one maybe a couple of years ago when rates started going up. Both those corrections never really hit the double digits. So even if you buy just before one of those corrections, which is maybe once every 8 years, you can still average your that loss through the gains, and you're going to be far in front.
I love the corrections, mate.
Yeah.
Do you know why? Because I buy properties those years, mate. I bought 3 properties in the GFC. That was a great year.
The only thing then is that some people are waiting for the correction to buy.
Yeah, that's true. They're waiting for that thing to dry, and it's honestly, I don't foresee it happening in the next 10 years.
And no one really gets it right. No one can actually pick the top and the bottom of these cycles. So if you're waiting to arbitrage the market, you're
getting a little further behind. The train's left the station.
Exactly.
Right? Yeah. No. All right. Is there anything, I guess, investors you would recommend they could do to speed up their journey to get $5 million plus asset base?
Well, like I
without doing it unsafely.
Yeah, look, like I said, look at your finances and adjust your household expenditure accordingly. The other big one that I keep talking about is the superannuation conversation. So many people go, oh, I don't really have much in super. I've only got like $150,000. And we say to those people, when did $100,000 and $150,000 become not much? Because that is a lot of money, and you could easily purchase. In these case studies, we've given a great investment at $700,000, and within 10 years, you could have a $5 million portfolio. And especially in your super, it would be tax free if you hang on to retirement. But that once again goes back to making some phone calls, putting a bit of effort in, setting up the self-managed super fund, looking if you do only have, let's say, $50,000 to $75,000 in your superannuation, partner with someone else that's willing to buy a property as well long term. The good thing I like about the super is that it is a set and forget. So you will buy something and just park it there, unlike other investments. So that's probably my biggest focus point to wrap things up.
Perfect. Well, I've just got a couple of final takeaways and then we'll wrap up. So I think, look, if you're just starting out on your journey, I definitely advise you to get going, get started and buy your first property. Well, that's going to really set the scene for your capital growth and the leverage factor you've got. If you're like a mid-stage investor, you're in that accumulation phase, keep on going. Focus on scaling, getting that growth and leverage your equity, harvesting that equity to get your next one. If you are approaching retirement and getting on in years, think about reducing your debt. Think about rebalancing your portfolio. Think about higher yield assets. Don't be afraid to sell and don't be afraid to buy something that's going to replace and use your capital a lot more efficiently. And finally, I just encourage you to have a strong team as well. I keep saying this as well. And really just have an action plan that's going to get you toward those goals, because there's nothing more satisfying than having a plan, taking action and looking back and going, yeah, we've done it. Because if you don't do it, then there's a big opportunity cost and your retirement years will be much more limited with choice.
All right, Rich. Well, I think we've covered some really great points here today. It's been some interesting discussion topics that a lot of our listeners have been hearing and seeing online, and it's great to spend some time to dive into these in more detail. If anybody wants to reach out to Rich and actually discuss purchasing a property, just, I guess, log onto your website.
Propertybuyer.com.au, and all the data's there and love to help you.
All right. Well, fantastic. Thanks for coming on board, Rich, and we'll look forward to reviewing some of these things in 6 to 12 months' time.
Thanks, Theo.